Greetings and namaskar, valued listeners. Welcome to our Commodities podcast, your source of the most recent development and valuable insights from the dynamic realm of commodities. I'm your host Ravindra Rao, representing the Kotak Securities Commodity Research Desk. In today's episode, we are poised to explore the crucial occurrences and emerging patterns that will undoubtedly influence the trajectory of commodity futures market in this week. The initial positive sentiment in the markets proved to be short lived due to increasing speculation that persistent high US inflation would result in elevated interest rates. Without a doubt, the standout economic event for the last week was the release of US CPI data. This followed a mixed labor report from the previous week. The information which indicated a slight easing of US inflation provided some relief and bolstered the notion that Federal Reserve might consider a pause on its actions come September. The figures were largely in line with expectation, with the headline inflation slightly rising to 3.2%. However, the core CPI eased to 4.7% in July. This marked the end of a 12-month consecutive decline in headline CPI since its peak of 9.1% in June 2022. The moderation in core CPI indicated the smallest month-to-month gain in over 2 years. In spite of these shifts, the dollar index remained elevated and treasury yields surged due to the belief that US would steer clear of a recession, thus maintaining higher interest rates for a prolonged period. Throughout the previous week, statements from Federal Reserve officials presented mixed opinions. Nonetheless, there was a general consensus for maintaining higher rates for an extended duration. The dollar saw a notable surge, reaching a 1 month high of 102.79. This was primarily attributed to safe haven buying triggered by Moody's decision to downgrade the credit ratings of several smaller US banks and placing major Wall Street entities under negative review. On the commodities front, in the past 3 weeks, COMEX gold has experienced a continued decline, partly due to indications from the recent US CPI report that Federal Reserve might keep rates elevated for a longer period without triggering a recession. This scenario supported the dollar's recovery from lower levels of below 102. Simultaneously, higher treasury yields exerted downward pressure on the non-yielding bullion, driving its prices to approach a 1 month low and record its weakest weekly close in 7 weeks. Concerns over the health of the US banking sector and weak Chinese economic data caused both the dollar index and the US benchmark treasury yields to rise, leading to a safe haven shift towards the dollar. Moody's Investor Services downgraded multiple American lenders, signaling potential concerns for larger firms as well. China's disappointing exports and imports added to anxieties about the world's second largest economy, further boosting the dollar. The rise in 10-year Treasury yields was attributed to increased government bond issuance, restricting potential upward movement in gold prices. In the week, there is an anticipation that gold prices might observe a recovery based on the forthcoming dovish FOMC meeting minutes scheduled for release this week. However, any upward movement could be limited. The improved outlook for US inflation indicates that US could evade a recession, potentially affecting gold's traditional role as a safe haven asset in times of economic uncertainty. The robustness of the US economy also allows the Federal Reserve to maintain higher rates until inflation aligns with the 2% target. Meanwhile, weaker sentiments from China and Europe continue to support the strength of the dollar. To see a substantial increase in gold prices, there would need to be signs of a slowdown in the US economy, leading to a weakening of the dollar. On the price action front, dollar index has breached the 60-day moving average of 102.50, which we mentioned in our last podcast, which was the immediate hurdle, and is approaching the 200-day moving average of 103.57, which is possible in this week. But we need to see whether it sustains 103.57 200-day moving average or it corrects from there, because it has not tested the 200-day moving average since December 2022. So there is a great chance that from 103.57, 103.60, we might see some kind of a corrective move in the dollar index. On the precious metal front, gold spot gold has breached the $1930 support, which we had mentioned last week, and is trading below that. The next strong support would be near 1904, which is the 200-day moving average support. We expect the prices might take support near 1904, and from there we might see some kind of a recovery, which might extend till $1930, which has now become the resistance. And above that, the strong resistance is near $1950. So there is a possibility we might see some corrective move initially, but then some recovery can be seen from the lower levels. In case of silver spot, it has breached the $23 support, and is also trading below the 200-day moving average. Now the next best support is near $22.10, from where we had seen a good recovery in prices, which went up till close to $26. If that holds, there is a possibility we might see a recovery till 23.27, which is the 200-day moving average resistance. In silver also, there is a possibility we might see some kind of a down move initially, but then maybe after the FOMC minutes release, we might see a recovery in both the precious metals. China's lack of specific stimulus measure, despite ongoing signs of a fragile recovery, exerted downward pressure on the base metals, with the declines ranging from 2% to 5%. Both the consumer price index and producer price index contracted in July for the first time since November 2020. Furthermore, China's exports and imports decreased by 14.5% and 12.4% year on year in July, respectively. In the week, significant attention will be on China's retail sales and industrial production figures for July. China's persistent weak demand and increasing deflation risk are evident in new loan reaching their lowest monthly level since 2009. This has prompted discussions on the necessity for policymakers to implement monetary and fiscal stimulus measures, despite concerns about the economy's high debt levels. On the price front, as we still maintain a positive move in zinc prices. Zinc, we have been telling that the bullish engulfing pattern has strengthened the zinc upside momentum. Zinc tested around 228 in the recent sessions, but from there we have seen some kind of a corrective move. On the lower side now, support is near 215.80, which is the 60-day moving average, and below that, the next support is near 211. So any corrective move might trigger buying in zinc prices until and unless the 204.85 support holds on the downside. In case of copper, copper has come close to the 200-day, the 60-day moving average support of 724.80. The next support from here on is near 718. So until that holds, we might see some kind of recovery. The broad range for the week would be 722 on the lower side, and on the higher side 728 to 734 would be the upper bound, and 736.50 is the 200-day moving average, above which we can say that a temporary bottom is in place. Finally, coming to crude oil experienced reversal in its gains earlier in the week as the strength of the dollar pulled prices lower from the resistance. However, there is a positive aspect, as the international energy agency, that is the IEA, pointed towards a tightening market for this year. This was further reinforced by an OPEC report suggesting a substantial supply deficit of over 2 million barrels per day in this quarter. On the price front, NYMEX crude, uh, excuse me, NYMEX crude is expected to take resistance close to 85 $85. We have seen a bearish candle formation on Thursday, and if the prices close below $82, there is a good chance that it might once again fall towards $79. So until and unless $85 holds on the upside on a closing basis, there is a possibility we might see some kind of a corrective move in crude this week, which might extend till $79 on the lower side. To wrap up, our focus for the week would be on an array of Chinese data, US retail sales figures, and the release of FOMC meeting minutes. Given the slightly dovish stance of July FOMC minutes, the minutes might reveal that most Fed officials viewed the progress on reducing inflation positively, while retaining uncertainty about whether the rate hike cycle has concluded. We hope that this commodities podcast has provided you with valuable insights and information. As always, we encourage you to stay informed and stay well.